Today, let's talk about the world's largest maker and distributor of analog semiconductors, Texas Instruments. They recently raised their dividend 13%, and as much as I like that, I'm not surprised by it. I mean, we're talking about a company whose previous 5 annual dividend hikes were 13%, 17%, 24%, 24%, and 32%. As a dividend growth investor and the caretaker of the growth and income portfolio, that matters to me. Quality matters even more. And in Texas Instruments, we have a company that's been an industry leader and an innovator, and a business whose products are in higher demand than ever. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I get started, please do us a favor and help us grow our channel, okay? Pop the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Alright, now let's talk about Texas Instruments' history, its winning business model, and why the stock might fit into a dividend growth investing portfolio. In 1930, Eugene McDermott co-founded a company called Geophysical Service to do seismic exploration for America's growing petroleum industry. During World War II, the company began making submarine detection equipment, beginning a long relationship providing electronics for the U.S. military. McDermott and 3 partners bought the company in 1941, and 10 years later they reorganized the company and changed its name to Texas Instruments. In 1953, the company went public and began trading on the New York Stock Exchange. The following year, Texas Instruments designed and manufactured the first transistor radio, the iconic Regency TR-1. The first integrated circuits came in 1958, and that led to the use of those circuits in computer logic during the 1960s. Texas Instruments invented the handheld calculator in 1967, and they eventually became famous for graphing and scientific calculators as the devices became capable of more and more complex tasks over the ensuing decades. During the 1970s and 80s, TI became a leading consumer electronics company, producing digital clocks, watches, and home computers. Texas Instruments actually lost a lot of money trying to make it in the hyper-competitive world of personal computers before they finally sold the product line to Acer in 1997. Around that time, Texas Instruments also formally exited the defense business, selling that part of its operations to Raytheon. With those moves, Texas Instruments became laser-focused on semiconductor development, manufacturing, and sales, and that remains where their focus is to this day. TI has become the world leader in analog chips, which are used to convert real-world signals, such as sound and temperature, into digital signals that can be processed. Texas Instruments now makes about 80,000 products to serve nearly 100,000 corporate customers around the world in markets that include industrial, automotive, personal electronics, and communications equipment. They operate 14 manufacturing sites, 10 wafer fab sites, and 7 assembly and test factories. Given that seemingly everything in the world needs semiconductors to function today, Texas Instruments is an important company, and Morningstar analyst Brian Colello does a nice job of explaining the attractiveness of TI as an investment. We remain encouraged with Texas Instruments' relentless focus on higher margin analog and embedded semiconductors, and when combined with smart operational moves on the manufacturing front, we foresee robust free cash flow generation in the years ahead. Since analog chips are neither particularly expensive nor do they require cutting-edge manufacturing techniques, high-quality analog chip makers tend to retain design wins for the life of the product, yet maintain healthy pricing and strong profitability on such sales over time. Additionally, Texas Instruments' size allows the firm to compete across a broader spectrum of industries, without its fortunes tied to a single customer or end market. The Internet of Things is an interesting tailwind for TI, as a company's chips could be key components in a massive array of new electronics devices with improved connectivity and processing power. I happen to agree with Morningstar's analysis, and it's why I bought more Texas Instruments stock for my growth and income portfolio in December. Earnings have quadrupled for TI since 2013, with double-digit growth in earnings per share almost every year. Trade tensions between the United States and China dented the bottom lines of Texas Instruments and other chip companies in 2019, but EPS has recovered significantly since, with 44% growth over the last year. It's also been a great year for sales, with $17.6 billion in revenue over the last 12 months. Financial metrics such as return on equity, return on invested capital, and operating margin also have been excellent for Texas Instruments, which is something of a free cash flow machine. Value Line includes Texas Instruments on its list of low-risk stocks with high return on equity and points to its 5-year average of 51% in that department. Despite all these positive metrics, Texas Instruments' stock price stumbled after a hot start to 2021. Hurt by supply chain issues and other concerns, TI actually experienced negative total return after April 5th. That's a stark contrast to its market-crushing performance over the preceding 1, 3, 5, 10, and 20 years. Jefferson Research says TI's fundamentals, such as balance sheet, earnings quality, and cash flow quality look great, and the price pullback inspired them to improve the valuation rating for Texas Instruments from medium risk to low risk. In other words, they think the stock is now more appealing to investors. Analysts generally see a solid year ahead for the company's stock, with 10 of the 15 monitored by TipRanks calling Texas Instruments a buy. Their average 12-month target price suggests about a 15% upside. Morningstar's analysts estimate Texas Instruments' fair value at $166, meaning they think it's overvalued now. But target prices from other analysts suggest TI stock is fairly valued, including Piper Sandler at $250, Argus at $225, Citigroup at $220, Baird and Credit Suisse at $200 apiece, Zacks $198, Morgan Stanley $195, and CFRA at $190. A comparison of Texas Instruments' forward PE ratio and forward PEG ratio to the 5-year averages also suggests that the stock is fairly valued. Texas Instruments obviously is not a screaming stock buy, so whether TI is at a value that makes you want to add it to your portfolio obviously is up to you. But one thing that's hard to dispute is the quality of the business. TI gets top scores for financial strength and safety from Value Line, wide moat and exemplary capital allocation ratings from Morningstar, a solid A+ credit rating from Standard & Poor's, and a very safe 90 grade from Simply Safe Dividends. Now let's talk a little more about Texas Instruments' reliable and growing dividend. The company has been increasing its payout annually for almost 2 decades, and it's been one double-digit dividend raise after another. The 13% dividend increase that the company announced in September helped boost Texas Instruments' yield to about 2.5%. One reason the dividend is considered safe and likely to keep growing is that the company has the free cash flow to easily cover the payout. The dividend has played a major role in Texas Instruments' thrashing of the S&P 500 index over the years. In this graphic from FastGraphs, you can see that TI has easily outperformed the index over the last 15 years, even without dividends factored in. But add in those divvies, and a $10,000 investment in TI has turned into about $73,500, which is a compound growth rate of more than 14%. A $10,000 investment in the S&P 500 index would have been worth about half as much. That's one example of how growth and income can work together to make a stock a winning investment. My growth and income portfolio was launched in 2020 as a means to help eventually pay for the college educations of my now 2-year-old grand twins, Logan and Jack. Growth is the portfolio's first name, and there's definitely an emphasis on growthier businesses. But I'm a dividend growth investor myself, so I also want to build a strong income stream over time. Making small investments every month to companies such as Texas Instruments will help me do just that. The GIP owns 17 stocks, and as 2021 ended, the portfolio's value was approaching $5,000. If you want to learn more about the growth and income portfolio, please check out the link in the description. Sign up for a free subscription to the Dividends and Income website, and you'll be notified about the stocks I'm buying for the portfolio. I also manage the Income Builder portfolio for this site, and the link to the IBP homepage is in the description too. Okay, that's all for now, folks. Again, if you value our content, please give us a thumbs up, subscribe, and ring that notification bell. Take it easy, everybody. Back at you soon.